There was a major shift underway in the global financial system, and it's showing up most clearly in the gold market. Gold isn't just rising in price anymore. It's becoming a strategic cornerstone of monetary policy, reserve management, and global economic defense. When you zoom out and look at the actions of central banks, institutional investors, and even major banks like JPMorgan, you begin to see why gold is not just a hedge. It may be the foundation of the next era of money. In 2025, gold experienced a historic rally. Prices soared to record territory, with spot gold surging past $4,500 per ounce and ending the year substantially higher than in prior years. This marked one of the strongest annual gains in decades, driven by a combination of central bank demand, geopolitical uncertainty, inflation concerns, and expectations of major interest rate cuts by the U.S. Federal Reserve. Analysts widely cite 2025 as a breakout year for gold, one that redefined market expectations. But the 2025 rally was not a flash in the pan. It reflected a structural change in the way sovereign actors and institutional managers view gold. According to forecasts from major financial institutions, this trend is far from over. JPMorgan Chase internal research projects that gold could average over $5,000 per ounce by the fourth quarter of 2026, driven by sustained central bank accumulation and heavy investor demand. Other major banks agree. HSBC sees gold hitting $5,000 per ounce in the first half of 2026, while Goldman Sachs has raised targets toward nearly $4,900 by late 2026. This institutional consensus underscores a major reevaluation of gold's role in worldwide portfolios. To understand why this is happening, you have to look at the forces driving the demand: central banks and sovereign reserve managers. For years now, official sector demand for gold has been rising dramatically, and not just in small increments. Central banks have recorded multiple years of net purchases far beyond historical averages, often exceeding 1,000 metric tons annually of gold additions to official reserves. This is part of a long-term strategy to diversify away from traditional fiat assets like U.S. Treasury bonds and reduce reliance on the U.S. dollar as the dominant reserve currency. Data from surveys and reserve reports shows that a very high percentage of reserve managers expect their gold holdings to increase over the next 5 years, even if prices are near record highs. In a recent World Gold Council survey, over 70% of central banks reported plans to increase gold holdings, while a growing number expect their dollar-denominated reserves to decline as a share of total reserves. This is not opportunistic buying. It's strategic repositioning on a global scale. Emerging market central banks have played a particularly active role. Many of these economies have lower proportions of their total reserves in gold compared to the US and Europe, and they're increasing allocations to catch up. For example, countries like Brazil have made significant recent purchases, adding tens of tons of gold to their reserves as part of a broader diversification strategy. Other emerging economies are initiating similar moves, aiming to strengthen monetary sovereignty and reduce exposure to currency volatility. But reserve accumulation is only one piece of the puzzle. Institutional investors, which include large investment funds, exchange-traded funds, ETFs, and commodity portfolios, have also shown sustained appetite for gold throughout this rally. Unlike earlier cycles where gold demand came mainly from jewelry or speculative trading, modern gold flows are heavily influenced by institutional strategies, seeking stable, non-correlated assets amid uncertain macroeconomic conditions. ETF inflows remain robust, and futures positioning by major players reflects growing conviction in gold's long-term role. Add to this a macroeconomic environment characterized by expectations of decreasing real interest rates and a weakening US dollar, conditions traditionally supportive of gold, and you begin to see why projections are aligning toward higher prices in 2026 and beyond. A weaker dollar makes gold relatively cheaper for holders of other currencies, and lower yields on bonds make non-yielding assets like gold more attractive by comparison. This shifting landscape creates what many analysts call a supply-demand imbalance. Physical demand from central banks and institutions continues to rise, even as mining supply remains constrained due to geological and production limitations. Gold mining production can only increase marginally each year, and it takes years, often a decade or more, to bring new production online. In contrast, demand from official and institutional buyers is immediate and relentless. So what's unique about this period? It's the convergence of demand from multiple powerful sources. Central bank buying, institutional flows, geopolitical risk sentiment, and the repositioning of global reserves are all creating a backdrop where gold is increasingly valued not just for price performance, but as a monetary asset with fundamental importance. This shift is what JPMorgan and other major banks are highlighting in their forecasts. Not simply that gold prices will rise, but that the market could experience a structural shock as these underlying forces intensify. A structural shock means a rapid movement in price that doesn't follow the gradual patterns of normal supply and demand. Instead, it reflects deep shifts in global macro strategy, such as reserve diversification, currency hedging, and risk management for entire economies and financial systems. When central banks begin acting more like strategic investors, absorbing significant portions of available supply, prices can accelerate rapidly because the physical market tightens much faster than mining or recycling supply can respond. One factor reinforcing this potential shock is the de-dollarization trend. Many reserve managers are reducing their exposure to the US dollar while increasing gold allocations. This trend isn't merely speculative. It, as a response to persistent global uncertainty about currency stability, fiscal deficits, and geopolitical fragmentation. In the World Gold Council survey, a high percentage of reserve managers reported expecting lower proportions of dollar assets in their portfolios over the next several years. Even analysts outside of JPMorgan see similar dynamics. Morgan Stanley forecasts continued strength for gold through 2026, while Deutsche Bank has raised its forecast and even sees gold prices approaching or surpassing $5,000 per ounce in that period. These projections reflect broad institutional conviction that gold's role is changing fundamentally, from a hedge asset to a core reserve instrument in a world of uncertain monetary policy. Another key element to watch is investor sentiment. As gold's price hits new highs, participation in gold markets, through ETFs, bullion, and futures, often accelerates as more investors seek exposure. While some analysts warn that extremely high prices could dampen retail demand temporarily, sustained institutional activity tends to support prices even in the face of short-term pullbacks. When you combine all these elements, central bank accumulation, institutional flows, de-dollarization strategies, and macroeconomic stress, you begin to understand why a massive price shock isn't just possible, it's structurally plausible. A shock doesn't always come from a single event. It can be the cumulative effect of many smaller developments pushing the market into new territory. In essence, gold today is no longer just a hedge against inflation or crisis. It's becoming a monetary anchor, a reserve asset that nations and institutions increasingly depend on as traditional fiat currencies face pressure. The strategic alignment of these forces, highlighted by JPMorgan AS bullish forecasts, suggests that the gold market is entering a new chapter, where the very framework of global reserves is being rethought. If these trends continue, sustained central bank demand, strong institutional flows, and a macro environment favoring safe haven assets, gold's trajectory could be far steeper than most people expect. The next few years may not just see higher gold prices, they may see gold assume a new level of importance in global finance.